Hey guys, welcome back to my Zephyr's Mortgage in Motion, actually out in motion for the first time in 3 months. Very exciting. Wanted to talk to you guys today about second mortgages and Helocs, home equity lines of credit. Those are those acronyms that we in the mortgage industry love so much. So second mortgage is basically second lien to your first mortgage. So that is pretty self-explanatory. You can either get them to purchase the home, meaning maybe you're approved for your first mortgage and it's not quite enough and you need a little bit more for down payment kind of, or maybe that program just makes more sense to have that second mortgage. You can get it as you go to purchase the home, and that's called a purchase money second. And then there's the traditional home equity line of credit, which typically this is a 20-year loan with a 10-year draw period. So when you, perhaps you've owned the home for a year and you want to be able to access the equity in your home, you can go to your bank or your favorite lender like me, and we can talk about doing a second mortgage home equity line of credit. So these are 20-year loans, 10-year draw period. Typically they are not a fixed amount, meaning you can use it kind of like a credit card. So that balance is changing. So it's really difficult to have it, fixed and locked in. So you can draw from it for 10 years. So you don't have to take the full balance out right away, typically. And you can use those funds however it is that you see necessary, home improvements or whatever. There are those that are fixed in where let's say you pull out $100,000 and then you just basically have a $100,000 loan that you're going to pay down. Those are probably a little bit more safe, but not always perfect, because what if you actually don't need that entire $100,000 right when you close on that loan? Let's say you only needed like 20, but you wanted to be able to access that other 80 later down the road. You wouldn't have to pay interest on that part you didn't use. So that's the benefit of having a equity line of credit versus a fixed second. But it's good to know that those interest rates also do change. So good morning. Those interest rates do change when it's not a fixed mortgage. So you need to be prepared. Worst case, what is the highest balance you're approved for? What's the worst case of what the interest rate can go to? So that you can kind of plan it out. Because I've known some of my clients who pull out a second mortgage and then that interest rate changes and goes up because the market is constantly changing, and then they can't afford that payment. So that is home equity line of credit, second mortgage. Oh, and the second mortgage is in order of importance, of course. So your first mortgage, your traditional 30 or whatever, that's going to be in first lien, right? And then if you pull out the second, that is in second lien. So the order of that is important, because if for some reason there is a foreclosure, the first lien is going to be paid first when that happens. It's also, likely the bigger balance as well. But the second mortgage, you're going to have paid second. So that means it's subordinated. It's not in first priority to be paid. So anyways, that's a really quick version of Heloc and second mortgages. Always happy to answer any questions that you may have. And again, this is Zephyr's Mortgage in Motion. I'm out.